Today, folks, a window of opportunity has just presented itself for those of you that want to print insane, juicy dividends, but also see absurd capital gains over the next 3 to 5 years. I'm telling you, not financial advice, but this Silicon Valley bank bringing down the entire financial sector with it doesn't make any obliterate sense, especially the Canadian banks that don't have any real representation to that bank whatsoever. So we're going to be discussing U.S. banks, Canadian banks, why there's this buying opportunity, and why I'm taking advantage of it right damn now. Obviously, my portfolio is down like $15,000 to $20,000 just in the last 5 days. We're going to be discussing all this and more. So hit that like button, folks, because it's not just the banking sector that's bringing down the entire markets. In fact, I mean, if you watch the markets yesterday, it was really abysmal. Today is just as abysmal in the market open. And a lot of this is still being driven by the CPI, the inflation numbers, especially in the US, that came out at 0.4% for February, which annualized is well over 4%. The Fed going to come down with a hammer on this, guys. We're going to see a 0.25% to a 0.5% increase on the interest rates going back to the 2008 levels, which is going to really squeeze the crap out of real estate investors. In fact, we're seeing it already. If you don't watch Ben Malley, you should take a listen to this because it's kind of funny.
And now I got to pay $6 million a year more in interest on $200+ million. If I would have been happy at 3, even though I was at 2. Now it's 6+%. That's $12 million a year in interest. I need 500 grand a month out of my pocket every month to give to the bank.
But you got tenants.
Can't raise the fucking rents, they're in leases.
Now, obviously, this puts a lot of strain on a lot of different aspects of the financial market, but the fact is a lot of people, even Ben, can afford to make those payments, and banks are inevitably going to benefit, and they are benefiting now from the higher interest rated environment, but they have to put extra loan loss provisions aside to protect themselves against the shaky loans, and we're going to spend at least the next 6 to 12 months shaking those bad loans out. But once we get through that, guys, and I think a lot of it's already been priced in, these banks are going to freaking print because they're not going to go under here, guys. Outside of maybe Silicon Valley, that's like the crypto bank of like venture capital. Yeah, it was high risk. We can see some of the pain there, but it brought down every other financial stock with it. Look at Charles Schwab Corporation. This is the company I use. I buy their ETF products like the Schwab US Dividend Equity ETF, and it witnessed its worst single day in its entire history. Over a couple days, dropping 31%. And the CEO has been coming out saying, hey guys, we're not that bad. We're actually really good. There's nothing really bad here. We got trillions of dollars in assets, lots of liquidity, lots of cash still coming in. People aren't flooding their money up. Damn it, it's a $100 billion bank. And look at the last day here. The stock is rallying against the market selling off, and people in our chat group, we've been discussing this daily. We're smart enough to figure out this was a buying opportunity, picked up some cheap shares. So congrats to you guys. And if you want to see these discussions, chat with me 24/7, 7 days a week, please go to the Patreon page, guys. Support the channel if you love the content. It's less than a Starbucks coffee a month. You sign up to this, you'll see the top pinned post has the WhatsApp link in it, and you can just chat about this stuff when I'm not posting videos every day. But take a look at the Charles Schwab US Dividend Equity ETF here, guys. This one is now seeing like a really bad sell-off, and again, most of this happening in the last 5 days, down 5.3%. This thing is yielding well over 3.5%, and I think it's just getting hindered because obviously the broader market sell-off, but 20% financial exposure's been really hindering this one as well. And again, I just think it's presenting a buying opportunity, but this comes back to the point of what Kevin O'Leary says. You know, you don't want any more of your entire portfolio being exposed, no more than 20% to a single individual sector, and this is why I broadly diversify between a multitude of ETFs, because we'll talk about VDY and some of my highly financial exposed ETFs that are getting clobbered. But take a look at this, because this is US bank loan to deposit ratio stuff we've been sharing in the chat group. I appreciate the guys that have shared this because it shows the lowest risk deposit base, with obviously being JP Morgan, and then your higher risk being on the Silicon Valley bank side of things. But look at JP Morgan here, man. In the last 5 days, down 6.31%. Year to date, you know, it's just been kind of flatlining after those lows, but this thing is, if it drops more, I'd buy it. If I'm in the US, man, I'd be buying these every day of the week, because look at the numbers here. This company did record revenue for 2022. The last couple quarters, they beat earning expectations, and quarter over quarter just been growing steadily because they're just a super safe bank. And Jamie Dimon, we trust. I mean, the guy's a legend when it comes to the financial sector. Look at Bank of America. This thing is down dramatically. All these yielding well over 3%. And similar to JP Morgan, look at record revenues for 2022, quarter over quarter, seeing, you know, beating analyst expectations and roughly flat on the quarterly earnings and revenue. But that's the US side, right? I'm more fixated on the Canadian side that doesn't have any major exposure and are actually going to benefit in ways you wouldn't think to the Silicon Valley Bank collapse. And we'll discuss that in a moment because I get that exposure through VDY. And VDY, oh my God, is down 6-7% just in the last 5 days. It's probably like one of the worst weeks it's experienced in a little while. The yield's like over 4.5% at this point. And you got to be a little careful here, right? Because I've mentioned this before, you're taking exposed risk because 56% of this ETF is just in financials and energy's at 26%. So you kind of get a double-edged sword here because of energy, and it has been slowing down. If we start seeing lower revenue and earnings because energy's pulled back, this could also hinder this ETF. So there is some exposed risk here, especially with the 56% financial exposure, primarily being in Royal Bank in Toronto, Dominion Bank making up 25% of this entire ETF. In TD, guys, long term it looks great. In the last 5 days, it's down 8.5%, and it's almost paying a 5% yield. This is the second largest company in Canada, by the way, next to Royal Bank, which is currently paying a 4% yield and is down 5% just in the last 5 days alone. So obviously I am feeling this pain pretty dramatically. I got like 150 grand in VDY, but I'm definitely buying more of it today. But take a look at the other banks. Like Bank of Nova Scotia has absolute no exposure to the Silicon Valley Bank. And look at this, it's down, its yield is at 6.36%. It's sitting below 5-year lows. It's just incredible looking at this stuff. Look at Canadian Imperial Bank paying a 6% yield, also sitting toward its 5 years below its 5-year lows here. Which, oh God, my mouth is drooling just looking at this stuff. But let me tell you the extra benefits. A Financial Post came out saying, from the Canadian perspective, not only should the failure of SVB not have significant negative implications for our banks, but this crisis should actually be viewed as further vindication of the Canadian banking model, which is dominated by a few large and diversified players. Bank of Nova Scotia, this comes from one of their analysts there on March 13th. While the risk of direct contingent to the Canadian banking system appeared minimal, National Bank of Canada analyst Gabriel flagged some potential sore spots for Canadian banks, especially those with major recent acquisitions in the US. Now, this is really intriguing because BMO, for example, has just established a foothold in California where SVB did most of its business through its US $16.3 billion Bank of the West acquisition. Now, a lot of companies, even Royal Bank's got some exposure in California, but this is kind of like in tangent. I don't think there's like direct exposure to a major extent. There's a nice little chart here, but what I want you to read is at the bottom. Basically, DeChain, some other analyst here, said that the SVB fallout also makes TD's US $13.4 billion acquisition of First Horizon Corp more interesting, as TD has indicated that it does not expect to achieve regulatory approval by the proposed May 27th closing date and is trying to negotiate another extension. There's been speculation it might try to reduce its offer because banks are collapsing now. These major acquisitions for TD are actually going to become more favorable because they can negotiate better prices. And even what's really intriguing is Royal Bank is closing on another major $10+ billion deal to purchase the Canadian counterpart of HSBC. So stuff that's prudent to pay attention to because these banks are doing pretty much fine in my opinion. I'm like, I could be wrong. I mean, who knows what the hell's happening here? I just feel like throughout every historical crash, when it comes to the banking sector, it's so short-lived. It's like you get 6 to 12 months of negativity, people freaking out. And the fact is what are you going to do? Bail on your bank? You're just going to pull all your money out? You're going to go to crypto? A lot of people seem to think so, but I don't think so. I think the banks right now, guys, you buy them, come back to me in 1 to 3 years, and muy bien, you're going to be getting huge yields on your cost basis, and you're going to probably see some pretty absurd capital gains. So I'm going to be buying probably a couple $1,000s of more VDY today, but definitely going to be buying probably like $10,000 dollars worth of investments here probably in the next month because damn it, this is awesome.